Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Whirlpool Corporation Annual Report. Whirlpool Corporation offers a diverse range of businesses and services that cater to various needs of consumers. The company's primary products include home appliances such as refrigerators, freezers, ice makers, and laundry appliances. They also provide commercial laundry products and related accessories, cooking and small domestic appliances, and dishwasher appliances with their respective accessories. In addition to these products, Whirlpool markets a variety of brands including Whirlpool, Maytag, KitchenAid, JennAir, Consul, Brastemp, Amana, Insinkerator, Afresh, Gladiator, Swash, Everdrop, Esleben Delujo, Elica, and Acros. The company sells its products through various channels such as retailers, distributors, builders, and other manufacturers, as well as directly to consumers. Whirlpool's extensive product line and distribution network enable it to cater to a wide range of customers across North America, Latin America, Asia, and internationally. With over 100 years of experience in the industry, Whirlpool has established itself as a leading provider of home appliances and related products and services. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a company's stock price to remain stagnant over a period of time. The stability of a company's stock price is often influenced by various market and economic factors. One possible reason for Whirlpool Corp's stock price remaining unchanged in the past year could be a lack of significant news or events that impact the company's performance. This could include stable sales figures, no major changes in leadership, or no significant announcements about new products or partnerships. Another factor contributing to stagnant stock prices is market sentiment. If investors are not optimistic about the company's future prospects, they may be less likely to buy shares, leading to a lack of upward momentum in the stock price. This can be due to various factors such as industry trends, economic conditions, or global events that affect consumer spending habits. Additionally, Whirlpool Corp's stock price may also be influenced by its competitors' performance. If other companies in the same industry are experiencing growth and outperforming Whirlpool, it could lead to a lack of interest in investing in the company's shares. This can create a self-reinforcing cycle where investors become less interested in buying shares, leading to further stagnation. In conclusion, there could be several reasons why Whirlpool Corp's stock price has remained unchanged over the past year. A combination of factors such as stable sales figures, lack of significant news or events, market sentiment, and competitor performance may all contribute to this trend. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. Revenue recognition policies play a significant role in determining revenue growth or decline. The company's ability to recognize revenue from new customers, as well as the impact of customer payment history and published credit information, are crucial factors. Segment-specific drivers also contribute significantly to revenue growth or decline. For instance, MDA North America experienced revenue growth due to increased sales incentives, while MDA Europe faced a decline in revenue due to commodity price fluctuations. The company's acquisitions and divestitures have also had an impact on revenue growth or decline, with some segments experiencing significant changes. In addition to these drivers, macroeconomic factors such as global economic uncertainty, macroeconomic volatility, ongoing international conflicts, and production impacts or supply constraints have a significant impact on revenue growth or decline. The company's trademarks, including JennAir, Maytag, and Insinkerator, are also at risk for future impairment due to fair value exceeding carrying value. Overall, the drivers of revenue growth or decline are complex and multifaceted, influenced by both internal and external factors. Understanding these drivers is essential for making informed business decisions and developing effective strategies to mitigate risks and capitalize on opportunities. The net income of the company experienced significant fluctuations between 2023 and 2025. Initially, it increased by 1.7% from $481 million in 2023 to $488 million. However, this trend was short-lived as it decreased by $298 million from 2023 to 2024, resulting in a net loss of -$323 million. The following year, the company's net income rebounded, and increased by $641 million, from -$323 million in 2024 to $318 million in 2025. The profit margins also underwent changes during this period. They decreased by -0.9% from 16.3% in 2023 to 15.4% in 2025, with a slight increase to 15.6% in 2024. The decrease in profit margins can be attributed to various factors such as seasonal fluctuations, tariff actions, supply chain constraints, intense competition, and economic uncertainty. The company's financial performance was affected by several external factors, including inflation, interest rate increases, reduced consumer demand, and credit rating downgrades. Additionally, the pension plan and post-retirement health benefit obligations exceeded plan assets, further impacting the company's net income. The strategic portfolio transformation initiative aimed at higher growth, higher margin businesses also played a role in the changes observed during this period. The company's financial performance has been consistently strong over the past few years, with a notable trend of generating significant positive operating cash flows. In 2024 and 2025, the company reported operating cash flows of $835 million and $470 million, respectively, indicating a steady increase in its ability to generate cash from its core operations. This trend continued into 2026, where the company generated an impressive $850 million in positive operating cash flow for the full year. This level of performance suggests that the company's business model is not only profitable, but also efficient in terms of generating cash, which is a critical indicator of long-term sustainability and growth potential. The performance of various segments and regions within the company has been mixed, with some areas excelling while others struggled. On a positive note, the United States accounted for 39% of total employees, indicating strong presence in this market. Additionally, higher growth and higher margin businesses saw significant improvement as part of the strategic portfolio transformation initiative. The acquisition of InSinkErator also contributed to the company's success. Furthermore, MDA Latin America demonstrated growth with an increase in accounts receivable allowance from $33 million to $39 million, while SDA Global also showed improvement with a rise in accounts receivable allowance from $2 million to $3 million. However, not all regions performed well. The divestment of Russia and the Middle East and North Africa, MENA markets, was likely due to underperformance. MDA North America also struggled, with a decrease in accounts receivable allowance from $8 million to $12 million. These areas will require attention and improvement strategies to get back on track. Management is optimistic about the company's outlook, with a focus on transforming the portfolio into a higher growth and margin business. The strategy involves concentrating on three key pillars: small appliances, major appliances, and commercial appliances, with a goal of winning in the Americas and achieving a leading position in multiple countries. To drive growth and competitiveness, management is investing heavily in innovation, while also executing cost takeout measures to cope with macroeconomic challenges. Additionally, the company has set ambitious sustainability goals, including achieving net zero emissions across its value chain by 2050 through improvements in energy efficiency, electrification, and renewable energy. In terms of leadership development and employee engagement, management is emphasizing programs such as Leaders Teaching Leaders to foster a winning culture with an owner's mindset. The company also prioritizes employee safety, well-being, and inclusion. Financially, the company aims to achieve estimated earnings per diluted share of $6.25 by 2026, while financing its business through operating cash flow and debt. Capital allocation priorities include funding innovation and growth through capital expenditures, debt repayment, and returns to shareholders through dividends and or share repurchases. Management acknowledges potential risks, including uncertainty surrounding the global economy due to trade policies and other factors, but remains committed to executing its strategy and achieving its goals. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, the company acquired the InSinkErator business from Emerson Electric Co. in 2022. Additionally, it entered into a contribution agreement with Arçelik, which led to the deconsolidation of its MDA Europe segment as of April 1, 2024. The company also sold shares in Whirlpool India in 2025. On the other hand, the divestitures include the operations in Russia in 2022. The MENA major domestic appliance business was also divested in April 2024. Furthermore, the European major domestic appliance business was sold to Beko Europe in the same month. The company has also undergone deconsolidation of its Whirlpool India and MDA Europe segments as of December 31, 2025 and April 1, 2024, respectively. In a separate transaction, the company sold a non-core property through a sale-leaseback deal in Q4 2025 for $35 million. The company's financial activities have been marked by both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts over the past 3 years. Specifically, it paid $384 million in 2023 and 2024, and a slightly lower amount of $300 million in 2025. In addition to dividend payments, the company has also engaged in share buybacks. Notably, it sold 30.4 million equity shares in Whirlpool India via market transactions in February 2024 and another 14.3 million shares in November 2025. Furthermore, the company repaid $50 million in short-term borrowings in 2024, which is not considered a share buyback. Overall, these financial activities demonstrate that the company has been actively managing its cash flow through both dividend payments and strategic share buybacks. Concerns about inventory buildup and supply chain disruption are evident throughout the extracted summaries. One of the primary concerns is the potential for foreign competitors to preload finished product inventories in anticipation of tariff actions, which could lead to a surge in inventory levels. Supply chain constraints, trade laws, tariffs, geopolitical uncertainty, increased interest rates, and import/export controls all pose significant risks to supply chains. Suppliers may not deliver parts, components, and equipment on schedule or to the required quality, while single-source suppliers can create vulnerabilities if they cease or interrupt production. Labor disputes, labor shortages, and work stoppages at operations and suppliers can also disrupt supply chains. Furthermore, various events such as epidemics, pandemics, terrorist attacks, cyber events, armed conflicts, natural disasters, and government actions can cause supply chain disruptions. Raw material costs and availability are also subject to fluctuations and volatility, which could impact operations. The preloading of finished product inventories by foreign competitors in advance of tariff implementation is another concern, as it may delay the expected positive impacts of tariffs on finished appliances. The increasing inventory levels from $1,463, 2024, to $1,750, 2025, also suggest a potential buildup of inventory, which could be a sign of supply chain disruption. Overall, these concerns highlight the need for companies to carefully manage their supply chains and inventory levels to mitigate risks and ensure business continuity. That concludes the financial summary for Whirlpool Corporation. Feel free to comment below, and I will be happy to answer them when possible.